So let's be honest, most traders are out here just guessing, taking every single setup that they see, hoping that it works. But the reality is, guys, if you don't follow a strict A+ entry criteria, you're just another gambler. That's why you're inconsistent, that's why you're hesitant, or even worse, over trading and taking setups that don't even meet your model in the first place. Inside of this video today, I'm going to be breaking down my exact A+ entry criteria, literally step by step, so you can finally stop second guessing yourself and actually start executing like a professional. My name is Ben, some of you may know me as ICT Keswick. I trade live in front of thousands of people literally every single day, and I only take trades that meet this exact checklist. So make sure you watch until the end. I'm also going to be breaking down some live trading examples towards the end of the video so you guys can better understand this model. Let's get straight into it. All right, so let's start off with number one. All right, what am I looking for when I log onto my chart every single morning? This is 100% going to be a sweep of liquidity. All right, so we need to see a very clear either sweep of buy side or sell side liquidity. All right, even better if we sweep London lows or London highs or Asia highs, Asia lows. That's going to be more significant compared to just sweeping any buy side or sell side liquidity level. Now, it's very important that we see a sweep of external range liquidity. That is where you're going to see the most and highest probable trade setups occur when we are trading outside of the range and we sweep that level. All right, if we sweep a internal range liquidity, it's going to be a less probable setup. All right, so if we're strictly talking A+, we want to see a sweep of external range liquidity, either buy side or sell side. And if we sweep some sort of session liquidity also, like London highs or Asia lows, for example, that is going to be 10 times more significant. So that's going to be number one, what you're looking out for on the chart every single morning. All right, number two is going to be a displacement. So let's say, for example, we've just swept sell side liquidity. Now what you're looking for next is going to be a displacement in the opposing direction back above through that sell side liquidity level. That is what most traders out there fail to teach and also fail to execute, okay? So once we sweep a liquidity level, make sure price displaces back through that level it just swept, okay? If it displaces, but it doesn't break back above that liquidity level, that's not a valid displacement. Now, ICT does make a very good point when he explains this, and he refers it to as an elephant jumping into a paddling pool, for example, and all of that water displacing out of that pool, all right? That is exactly what you want to see on your chart when you're trading. A very aggressive candle, either higher or lower, that is going to count as a displacement. All right, guys, just a quick announcement. All right, apologies for interrupting the video here. The live trading community will be shutting down very soon. So if you're someone that has been on the sidelines for a while now and you haven't actually taken any action, now is your chance to secure your seat. We're actually also running a 50% off lifetime access sale for a limited time only. So this will allow you to capitalize on this opportunity the last and final time before we shut our doors. Now, anyone who joins right now will be locked in for life. However, any new members that try to join in the future will no longer be able to do that. So now's your chance, guys. Make sure to check out the links in the description, secure a seat, and let's get back to the video. Now, this actually leads on to number three. With displacement, usually will come a market structure shift. What is a market structure shift? Okay, if we've just swept sell side liquidity and we've displaced higher, what you're looking for is the most recent swing high to get broken through. Now, preferably what you want to see with an A+ entry criteria is when price actually displaces through that swing high, we need to see a body candle closure in order for that market structure shift to be high probability. If we just get a wick above that swing high, yes, the trade is still considered to be valid, but it's going to be 10 times more less likely to actually play out in your favor. So keep that in mind when you're following this A+ entry checklist. Now, number four is going to be your fair value gap. So after we sweep liquidity, we get displacement, we get that market structure shift. What comes next is going to be our fair value gap. Now, a fair value gap is a three candle formation. Bullish example being the first candle's wick high and the third candle's wick low, right? That second candle that displaces through, usually the inefficiency between the first candle's wick high and the third candle's wick low, that imbalance in the middle is going to be your fair value gap. So what you want to do is you want to have your entry usually at the edge of that fair value gap. As soon as price taps in, that is your entry point. Okay, so once you have your entry, you want to have a correct and valid stop loss. So this can either be below a swing low. Let's say, for example, you're bullish and you're going long. You're going to have your stop loss below a valid structure point, such as a swing low. If we are bearish, of course, it's going to be vice versa. You have your stop loss above a swing high. Now, the maximum amount of risk that you're going to be putting on the table when you're trading this model is going to be 30 handles. Please don't be risking more than that, because that is way more than enough. You're giving a lot of room for price to actually breathe and not stop you out prematurely. But yeah, that is a good amount of risk. All right, so once you have your entry, you have your stop loss, everything's in place, you want to target the opposing liquidity, meaning you're targeting external range liquidity. So if we've just swept buy side liquidity, what is going to be the next opposing liquidity? It's going to be, of course, sell side. So ideally, what you want to target is session liquidity as well. So anything like London highs, London lows, Asia highs, Asia lows is going to be a good draw on liquidity, a very strong magnet for price. Now, it gets better, right? If you see a very clean pair of relatively equal highs or relatively equal lows, this can act as a very strong magnet on price also, because most traders who trade retail concepts, they look at these levels and they refer to them as support and resistance. So they're expecting either a bounce or a rejection at these levels, whereas us ICT traders, we're expecting price to run towards those levels and through them levels. Now, number 7 is very, very important. I don't see many people talking about this on YouTube, and no one really mentions it other than ICT. So partial profits, okay? Along the way, you want to be taking partial profits. You don't want to have just one TP. You want to reward yourself, reduce risk, etc. So where do you take something off? You would measure 50% of the current price range. So in order to measure the current price range, you would measure from the most recent swing high to the most recent swing low of that price leg, okay? Now, with the Fibonacci tool on TradingView, that will allow you to find 50% of the current price range. Anything below 50% is considered a discount. Anything above 50% is considered a premium. Now, usually what you want to do is you want to target a inefficiency or fair value gap, either resting below in a discount or even resting above in a premium. Okay, it really depends what direction you're trading, but this is a very good area to take partial profits. Now, if there is no imbalance resting above or below that you can target, simply just target a internal buy side or sell side liquidity resting above or below 50%. That's a very good area to take something off your position and reduce a little bit of risk. So this actually leads me on to number 8, all right? Partial profits, you should be closing at internal range liquidity, which we know as fair value gaps, and any buy side or sell side levels resting inside of the range. And you should be closing your full position at external range liquidity, meaning outside of the range, like buy side and sell side liquidity levels. Okay, so number 9 is going to be very, very important. Okay, it's going to be asset correlation. So when you're trading NQ or the indices market in general, you need to be looking at the correlating pair, which is the S&P 500, which is ES. So you should have NQ on one side of your screen and ES on the other side of your screen. Now, let's say we swept liquidity, we've displaced higher, we've had that market structure shift, we've had a fair value gap, we've literally had everything that we need to see on NASDAQ. However, there's one thing missing on ES. Let's say there's no fair value gap on ES, but there is on NQ. You're simply not going to be taking that trade because the two assets are not correlated. What you want to see is ES have the exact same price action or very, very similar to what NQ already has. So if NQ has a very clean setup, but ES is not even showing that, you should not be taking that trade on NQ, because 9 times out of 10, guys, that is going to be a trap and you're going to get stopped out. I've seen it happen many, many times. And a lot of my students, they ask me, Ben, why has this failed? Okay, I've literally followed your exact A+ entry criteria, yet I've still failed. What is going on? And I say, listen, bro, you're not paying attention to the correlating asset, which is ES, okay? They're correlating pairs, guys. You have to pay attention to both. You can't just trade one. You always have to look at ES as well to see what type of price action it has and if it's actually correlating. That goes with anything, all right? If NQ displaces, ES doesn't, no valid trade. If NQ has a market structure shift and ES doesn't, again, no valid trade. The only time where this doesn't apply is a sweep of liquidity, because then we have a SMT, a smart money divergence. So if NQ sweeps buy side but ES doesn't, that's actually a good thing, okay? Because then we have an additional confluence that we can add towards our trade, which is actually in our favor and not against it, all right? So hopefully that makes sense. If it doesn't, drop a comment in the comment section down below and I'll try to help you to the best of my ability. Number 10, so going back to the entry, all right? Once you enter on that fair value gap, please make sure your entry is inside of the 945 to 10:15 New York AM macro. Okay, remember, all of these times listed are always going to be inside of the New York session. So yeah, what that means, guys, is if you get an entry 1 minute before the macro or 1 minute after the macro, you're simply not going to take that trade, right? You're only taking trades inside of this specific 30-minute time interval. And it's very important to stick to that, right? Because inside of the macro, that is where you're going to get the best and highest probable trades. And it's also where most of the algorithmic trades will occur. Now, let's say you get absolutely no opportunities inside of that first AM macro from 9:45 to 10:15, right? There are plenty of more macros that you can trade, okay? So the second AM macro that I recommend, and I trade myself personally, is the 10:45 to 11:15. And there's also a lunch macro from 11:45 to 12:15 and a PM session macro from 1:45 PM to 2:15 PM. Now, I myself personally, I don't trade the PM session because I actually backtested a whole year's worth of data and statistics, and the majority of my losses actually came from the PM session. So I just completely cut that out of my strategy, and now I only trade the AM session. So usually I will get an opportunity inside of that first AM macro. If I don't for any reason, I'll trade that second AM macro and then potentially the lunch session, right? But those are the only macros that I trade myself and the ones that I also recommend you lot follow. All right, so let's move on to number 12, red folder news, right? If you ever have any red folder news, such as Jerome Powell is speaking, or let's say, for example, we have 10 AM news, FOMC in the PM session, the AM session is most likely gonna be low probability. How I deal with 10 AM impact news, I'll usually wait for that news to come out before taking a trade, all right? So if we ever have any red folder news, of course, it's pretty obvious, right? Please do not trade during those hours because that's just simply gambling. All right, and finally, number 13, all right, this is gonna be the last one on the list. You need a clear bias, and the lower time frame needs to also align with the higher time frame. So what do I mean by that, right? The higher time frame, such as the daily time frame, you need to see some sort of bullish fair value gap or bearish fair value gap, some sort of PD array on that chart so you can actually build a correct and valid bias, right? Let's say, for example, we're in a daily bullish fair value gap with some relatively equal highs resting just above. Your bias is going to be most likely bullish. The same goes for if we're in a bearish fair value gap and we have some equal lows resting below, for example, then your bias is most likely going to be bearish, right? So before actually taking any trades, start on the daily time frame and find your bias, okay? Once you have your bias and the correct drawn liquidity, where price is going to head to next, then the next step is for you to align that lower time frame with the higher time frame. So if, let's say, we have a bullish bias and everything is bullish on the higher time frame, if you then see a bearish setup on the lower time frame, are you going to take that trade? Absolutely not, because it simply does not align with the higher time frame bias. Yes, you could take that trade, however, 9 times out of 10, it's most likely going to go against you and not in your favor because it's against the drawn liquidity and you're trading against the higher time frame draw. So it's going to be a very, very risky trade and I would not recommend it. So that is going to be it for the A+ entry criteria. Okay, I've literally listed out every single thing that I can think of on the chart here. So now that we've gone through all of that, I'm actually going to be showing you a few live trading examples so you guys can see this actually playing out in real time. Let's jump straight into it. All right, guys, so here we have a A+ entry criteria checklist, a bullish example. I post these on my Instagram, so if you're not already following me, go over to Instagram at ICT. I upload these pretty often, so a ton of free value and education on there for you lot to check out if you are interested. But yeah, anyways, as you can see, right, we've come down, we've swept sell side liquidity. So we had that liquidity sweep. Okay, that's number one. We need to see some sort of sell side liquidity get swept, preferably a external liquidity level. Once we've swept that level, right, the next thing that we're looking for is a displacement. So what do we get here, right? This candle comes up, clearly displaces, right? Notice how we had a body candle closure, so very aggressive. And we've also broken above that swing high there. So we've had a liquidity sweep, we've had a displacement, we've had a market structure shift. The next thing that we're looking for is a fair value gap. Okay, so what do we get next? We get a clear fair value gap. Now, this example here is actually even better. So the fair value gap is paired with another PD array, for example, a breaker block. So this up close candle here is going to be our breaker block. The more PD arrays that you have in one specific area, the higher the probability of that trade playing out is going to be. So let's say we have an order block there as well, even better. Okay, so look out for that on the chart. you're gonna have your entry on the edge of that fair value gap there, stop loss below the swing low. Now in this scenario here, we were actually risking more than 30 handles if we would have put our stops below the swing low. So the next place that you put your stop loss is going to be that displacement candles low, which is the second candle there, right? So we were risking around 30 handles in that trade. We entered long and we target the opposing liquidity. So the next draw on liquidity here are going to be these relatively equal highs. Again, going back to the checklist, please make sure you screenshot that checklist, save it for later, study it. We need to target some form of external range liquidity, whether that's London highs, London lows, Asia highs, Asia lows, relatively equal lows, relatively equal highs, right? Some form of liquidity has to be targeted. So in this case, it's going to be equal highs, and along the way, you want to take some partial profits. So what do we have in this scenario here, right? If we measure from this swing high to that swing low there, that's our current price range. So find 50% of that price range. It's most likely going to be somewhere around here. Okay, this is an Instagram post, so I can't actually get my Fibonacci tool out and start measuring. But 50% would be around this level here. Okay, so anything above 50% is going to be premium. Anything below 50% is going to be a discount. Since we're going long inside of a discount, we want to target a premium. So what do we have here? We have a unfilled fair value gap, okay, resting above in a premium. Great area to take partial profits. What do? We take some of our position off once price reaches this area, reduce risks, move stops, etc., and then target the external draw on liquidity, which is that high up here. And as you can see, we've obviously come up and we've taken those highs, final TP smashed. Entry as well is inside of that 9:45 to 10:15 a.m. macro, which is perfect. Notice how we've also tapped into a daily inefficiency as well. So not only have we swept liquidity, we've also tapped into a higher time frame bullish fair value gap, which is what you want to see when you're trading this model. You want to have a strong bias on the higher time frame, a strong draw on liquidity, and you want to align the lower time frame with the higher time frame draw and bias, which in this scenario we have clearly done. Okay, so this is literally textbook trade, A+ entry checklist. All right, I'm going to show you another example here. This is actually a bearish example. So number one, sweep of liquidity. We've come up, we've swept buy side, we've come down. Now, some people were actually messaging me about this trade and they were asking me, why did you not enter on this fair value gap here, right? Also, all of these posts that I post on Instagram, guys, these are all trades that I have taken myself personally. So if I post something, we have taken this in the past with the live trading community. But anyways, other than that, the reason why we did not take this gap here is because there's been no break of a swing low. There's been no market structure shift. Hence, we're not going to be entering a fair value gap if we haven't yet broken structure. What do you want to see next, right? You want to see a displacement that's paired with that shift in market structure. So the most recent swing low is resting just here, right? Price then breaks below that swing low. It's also broken below the buy side level that we've already swept, okay? So we've broken below both levels with clear displacement. We get a clear entry inside of that 9:45 to 10:15 a.m. macro, inside of the New York session, right? Your entry is at the edge of that fair value gap, stop loss goes above the most recent swing high, and then you target the opposing liquidity, which in this case is relatively equal lows. Look at those equal lows. Look how clean they look. A very strong magnet on price. So anyways, we enter short, stop loss above the high, and we target those equal highs. So anyways, we enter short, we've managed our risk correctly, and now we're just simply targeting the next draw on liquidity. As you can see, TP has been smashed. Very lovely trade. In this scenario here, we didn't actually get an opportunity to take any partial profits, and we simply just targeted the external draw. All right, guys, we've come towards the end of the video. All right, I hope you lot enjoyed. I hope you lot got some value out of this video. If you have, please leave a like, leave a comment, share, and subscribe. Quick heads up also, the live trading community is going to be shutting down very, very soon. So anyone that's currently inside is going to be locked in for life and will continue to stay inside. After that, no new members will be allowed in. Now, it's getting to the point now where there is way too many people joining, and I just want to have a set, strict amount of people that inside that group where I can answer the questions and it doesn't get too hectic, okay? So if you're not already inside, okay, now is your opportunity. Make sure to go secure your seat right now, because after this, the group's gonna be shut down forever. So as a bonus for you guys, I'm actually running a 50% off lifetime access sale. So you can actually take advantage of this opportunity and capitalize on it. So if you've been on the sidelines and you're watching the videos for a very long time now is your chance to secure your seat. So if you are someone that's interested, make sure to check out all the links in the description. But other than that, guys, I'll catch you lot in the next one. Take it easy.